The content of this podcast is provided for informational and educational purposes only and should not be construed as financial, investment, legal, or tax advice. The views and opinions expressed by the host and any guests are solely their own and do not reflect the views of any employer, firm, or affiliated institution. Any examples or strategies discussed are general in nature and may not be appropriate for your personal circumstances. Always consult a licensed financial advisor or other qualified professional before making any financial decisions. The host and production team assume no liability for any loss or damage resulting from reliance on the information provided in this podcast. Welcome back to Trajecta Talks. I'm your host, Alex Savanovich, and for those who've been with on us on this journey, you know we've covered the fundamentals, the advanced mechanics of securities, and the opaque world of alternative investments. On the last episode, we've established the foundation of what the market trades. Today, we're going to shift the gears completely. We're moving from what is traded to how it is traded, managed, and regulated in the 21st century. Our topic today is one of the most significant and influential technologies shaping modern finance. We're going to talk about artificial intelligence and machine learning. So, before we get into that, let's do the quick market update. So, first off, IPO season is heating up like a Black Friday sale, and we've got two big ones debuting this week. So, kicking things off, we've got Alliance Laundry Holdings, ticker is ALH. They priced their upsize IPO at $22 a share late yesterday, the high end of their range, pulling in a whopping $826 million. These are the folks behind your washing machines and dryers. It just went public on the NYSE with shares starting to trade as ALH on October 9th, closing the deal by October 10th. Backed by private equity heavyweights BDT and MSD, this one's all about scaling up commercial laundry operations in a world that's still spinning post pandemic. If you're into steady, not so attractive ish industrials, keep an eye on it. Could be a quiet winner in this volatile tape. Now, not far behind is Phoenix Education Partners, ticker PXED. This is the parent company of the University of Phoenix. They're eyeing a $1.2 billion valuation with 4.25 million shares on offer at a range of $31 to $33 a pop, listing on the NYSE tomorrow as well. It's a potential lifeline for the for profit education space, which has been battered by enrollment dips and scrutiny. Underwriters are betting on a rebound in adult learners chasing online degrees amid the skills gap. So a little bit risky, sure, regulatory headwinds are real, but if remote work sticks, this could potentially fly. We'll circle back next week to see how they both landed. Shifting gears to software that we love to watch, UiPath, it's ticker PATH, put on an absolute clinic this week, ripping higher on AI tailwinds that had us all glued to the charts. You know, the robotic process automation king extended its rally for a second straight day, jumping 12.5% yesterday, another 20% today to close at 14.5 yesterday, and I think closed close to 18 today. So let's talk about the flying taxis. Joby Aviation, ticker is JOBY, hit a speed bump with a $514 million common stock offering priced at a discounted $16.85 per share. Deal was underwritten by Morgan Stanley. They sold 30.5 million shares with an option for another 4.4 million green shoe. Gross proceeds were about $514 million to fuel their EVTOL certification push. But yikes, the market didn't love the dilution. Shares tumbled over 11%. Joby's been a cult favorite for urban air mobility, but this cash grab screams that we need some runway. Let's switch speeds a little bit, talk about Dell Technologies. Ticker symbol on that is DELL. Dropped jaws with their long-term financial framework update at an investor day this week. They're jacking up revenue growth guidance to 7 to 9% annually, double the old target, which was 3 to 4%, fueled by AI servers and edge computing demand. Non-GAAP earnings per share now eyeing about 15% yearly growth, with over 80% of free cash flow funneled back to shareholders via buybacks and dividends. After the news, the street definitely rewarded the optimism. Dell popped 7% intraday. So in a chip-hungry world, Dell's positioning as the enterprise AI backbone feels spot on. Now, speaking of strategic plays, the US government, continuing on theme so far this year, dipping its toes deeper into the critical minerals, rare earths, with a 10% stake in Trilogy Metals. I think it's a Canadian company. Ticker on that is TMQ, rare earth play up in Alaska. On the news, TMQ stock exploded over 200% in just one day on the news. So, talk about a Trump era pivot to domestic supply chains. China dominates rare earths, but this signals Washington's all in on reshoring. A little bit speculative, in my opinion, for sure. But with electric vehicles and defense demand exploding, TMQ is a name to watch for that next leg. Another one I've been watching is USAR and MP Materials as well. Not all the headlines were green this week, though. AppLovin, ticker APP, took a gut punch from an SEC probe into their data collection practices. I read that on Bloomberg. Regulators are sniffing around allegations that the advertising technology giant violated platform agreements to juice targeted ads. Think creepy personalization on absolute steroids. The shares tanked hard, wiping out $8.65 billion in paper. Now, I saved the fireworks for last. AMD just inked a monster 5-year AI chip deal with OpenAI that has the semis sector absolutely lit up. Announced on Monday, AMD is supplying hundreds of thousands of Instinct accelerators, 6 gigawatts of compute power for OpenAI's next gen infrastructure, with the AI pioneer getting warrants for up to 10% stake in AMD at a dirt cheap penny a share. AMD is a direct NVIDIA challenger, diversifying OpenAI's supply away from the GPU kingpin. So the result, AMD's stock was up 43%, absolutely massive. AI capex is flooding, and AMD's finally cashing the checks. If you're not positioned there, maybe you want to think about it. I think we're getting a little too stretched. It's up to interpretation. Now, let's talk about our episode for this week. This isn't a sci-fi podcast, as you know. This is a detailed look today at how algorithms are enhancing operations, influencing loan rates, and executing trades. We're going to break down how AI is enhancing the customer experience in banking, driving unparalleled operational efficiency across the fintech landscape, and most critically, playing a key role in quantitative trading where multi-billion-dollar decisions are guided by mathematical models. So, the goal today, hopefully, an insightful deep dive into the intersection of data science and dollars. Let's dive right in. So, for the average person, the first interaction with AI and finance is often through their banking app or a digital payment platform. This is where AI and ML, machine learning, I'm going to refer to it as ML, are dramatically improving the customer experience, making banking faster, more personalized, and crucially, much safer. Gone are the days of receiving generic emails about checking accounts. Today's sophisticated banking apps use machine learning models, specifically recommendation engines, to analyze massive data sets of your spending habits, saving goals, and transaction history. These models perform clustering analysis to group you with millions of similar users, allowing the bank to understand your life stage, financial needs with incredible accuracy. This leads to true hyper personalization. Instead of recommending a standard credit card, the system might recommend a specific mortgage refinancing product, a wealth management service, or even a specific savings goal based on a large impending expense. For example, could be college tuition or a car purchase that the AI has implicitly predicted from your spending patterns. This isn't just about selling products, it's about providing predictive and proactive financial wellness, although I would argue that it is about selling products as well, a little bit. AI can analyze your cash flow, identify when you're likely to overdraft in 3 days, and send you a preemptive alert asking if you'd like to automatically transfer a small sum from your savings. That level of predictive service transforms a potentially stressful error into a seamless interaction, boosting customer loyalty. The customer service industry has been significantly optimized by chatbots and intelligent virtual assistants. At the basic level, these bots use natural language processing to understand the intent behind a customer's query, be it, I lost my card or what's my balance. This is much more complex than a simple keyword search. NLP breaks down human language into structured, readable data through several sophisticated steps. So, first, the system performs tokenization, breaking a sentence into individual words or units, often called tokens. Next, it uses algorithms for named entity recognition to identify and classify key entities within the text, such as a credit card number, a date, or a specific transaction amount. Once the key components and the underlying intent, for example, dispute, transfer, check balance, are mapped by the AI, the system knows exactly what action to take. This more modern approach marks a crucial shift away from the rigid, old school, rule based systems that easily failed if a customer deviated slightly from a predefined script. Today, machine learning powered chatbots trained on millions of real world conversations are flexible and capable of handling nuance, slang, and even misspellings. And trust me, I use AI every day. I never spell words correctly and it still understands what I'm saying. For banks, the efficiency gain is enormous. Machine learning powered chatbots can handle 80% or more of routine inquiries without human intervention, saving millions in operational costs and allowing human agents to focus on high stakes, emotionally complex, or highly technical issues. A key metric here is first contact resolution, the ability to resolve the customer's issue on the very first interaction. So AI drives FCR rates up dramatically because of its speed and accuracy. So for the customer like you and I, it means instantaneous service 24/7, unless you have a much bigger issue that needs a human to assist. So some more advanced systems often use sophisticated transformer models, like those behind large language models, can even guide customers through complex processes like disputing a charge or applying for a personal loan, essentially acting as an automated, highly available service representative. Furthermore, the technology extends beyond text. Voice banking utilizes automatic speech recognition to transcribe spoken words into text, allowing the NLP to process queries through channels like smart speakers and mobile app voice commands, ensuring accessibility and deeper integration into the user's daily life. This continuous learning and expanded capabilities solidify AI's role not just as a cost saver, but as the new standard for seamless financial interaction. Perhaps the most essential and non negotiable use of AI, in my opinion, in the customer experience sphere is real time fraud detection. This is where AI acts as a digital guardian, protecting trillions of dollars worth of assets and transactions globally. So I think to truly appreciate the current state, we have to look at the past. Traditional fraud detection systems relied on simple, rule based logic. These rules were static, rigid. For example, if a transaction is over 5 grand and it happens in a foreign country, flag it. Now, while effective sometimes at catching very, very simple fraud, the system had two critical failures. It generated too many false positives, i.e., blocking your legitimate purchases while traveling. And more importantly, criminals quickly learned the rules and adapted their techniques to bypass them. So, more modern systems operate on an entirely different scale using deep learning and neural networks. So, instead of defining static rules, these models are trained on billions of legitimate transactions to establish a comprehensive, multidimensional profile of a user's normal behavior. This profile isn't just about where you shop, it's subtle, data rich, and constantly updating and learning from you. When a transaction occurs, the AI instantly evaluates hundreds of factors, often within half a second sometimes. One of those factors would be your transactional history. Is this a typical purchase category? Is it an average amount of what you would normally spend or frequency for this user? Geographic and temporal context is important too. Is the user or the customer logging in from a new city? Is the time of day unusual for them to be spending? If you typically don't spend past 9 p.m. because you go to bed, it's very weird to see a charge happen at 2 in the morning. Another factor is device and behavioral biometrics. Is the user typing speed or mouse movement consistent with their past behavior? Is the device ID known and trusted? The neural network assigns a risk score to the transaction. If the score deviates from the learned normal behavior, even subtle, non rule based ways that suggest a pattern break, it is flagged or automatically declined within milliseconds. This process has transformed the industry from reactive rule setting to proactive risk scoring. This technological leap is hugely beneficial. I mean, by lowering fraud losses for banks, the operating costs of financial institutions decrease. More importantly, for the customer, it significantly reduces those frustrating false declines, leading to higher approval rates for legitimate transactions and providing customers with greater security and deep seated trust in their platforms. So let's let's move beyond the customer facing side. AI is also a powerful tool for efficiency, as we all know, particularly in the complex areas of compliance, risk management, and operational automation, collectively accelerating how banks and new fintech companies operate. The financial sector is the most heavily regulated industry globally. Banks must adhere to strict rules on anti money laundering or AML and know your customer or KYC protocols. Historically, this was a manual, slow, and error prone process involving reviewing physical documents and cross referencing databases. Today, AI powered regulatory technology solutions automate much of this workload. So, for KYC, for example, AI uses computer vision to instantly process identity documents, verifies the information against global databases, and performs real time checks on sanction lists. And on the anti money laundering side, machine learning models analyze transaction patterns for suspicious activities much more effectively than human analysts. They look for money flowing through unusual routes, structuring deposits, or patterns associated with shell companies. Since machine learning models can process data 24/7 across borders, they provide a constant, robust shield against financial crime, reducing massive potential fines for banks and ultimately protecting you as a consumer. AI has also profoundly influenced how credit decisions are made, fundamentally altering the landscape for both consumer lending and small business financing. The move to AI driven models was necessitated by the inherent limitations of traditional underwriting. Legacy systems, heavily reliant on scores like FICO, primarily focused on a small static set of variables: credit history, income from salaried employment, debt to income ratio. This system was biased towards borrowers with long established credit histories and conventional employment, resulting in the unfair exclusion of the thin file population. That would include people like gig economy workers, recent immigrants, or young professionals who simply hadn't had time to build a history. This is why I say get a credit card in college and just put a couple purchases on it in a month just to start building that credit. This sort of thing creates an enormous inefficient gap in the market. So today, modern algorithmic underwriting solves this by massively expanding the scope of data used to assess credit risk. It moves beyond the narrow focus of the credit bureau report and incorporates vast and non-traditional data sets. These inputs paint a richer, more accurate picture of financial stability and willingness to pay. So let's talk about a few of those inputs. The first one's going to be payment behavior data. So they'll analyze utility bills, cell phone payments, and rental payment history, which traditional models often ignored or went through very slowly or manually. Consistent, timely payments on these bills are highly predictive indicators of financial discipline. Next is behavioral data. For small business loans, models might analyze e-commerce platform performance, invoicing history, or even accounting software records with permission. They obviously have to ask you for permission to gauge the health and velocity of the business's cash flows in real time. Next is affordability metrics. Instead of relying solely on annual salary, AI models can use bank account data analysis to determine a user's true residual income and spending habits, leading to a more dynamic and less biased assessment of the ability to service debt. This data is fed into sophisticated risk modeling algorithms, often utilizing techniques like random forests or gradient boosting machines, which are far more precise than older statistical methods like logistic regression, for example. These models estimate the probability of default with very, very high accuracy. The result is twofold. First, fintech lenders can responsibly extend credit to those previously locked out, creating massive market efficiency and helping to lower the cost of capital for a broader population. Second, the improved risk segmentation allows banks to offer more precise and thus more competitive rates to low risk borrowers, rewarding financial responsibility with lower interest payments. A critical consideration in this space, however, is fairness and bias. So, AI models learn from historical data. They can inadvertently perpetuate existing human or societal biases present in that data. Consequently, regulatory bodies increasingly require lenders to employ explainable AI techniques to ensure that credit decisions are transparent, non discriminatory, and fully compliant with equal opportunity lending laws. Let's move on to operational automation. Internally, large banks and insurance companies rely on robotic process automation, often augmented by AI to handle repetitive, high volume, and rules based back office tasks. So just imagine processing millions of loan applications or insurance claims. RPA robots powered by AI can log into multiple systems, extract data from unstructured documents, they can reconcile discrepancies, and initiate payment or follow up procedures, all without human intervention. This drives dramatic operational cost savings and, frankly, it eliminates human error, freeing up skilled employees to focus on maybe more complex problem solving rather than just your normal data entry. So let's move on to the final part of our episode, the quant frontier. For those of us on the trading and investment side, AI and machine learning aren't just tools for efficiency, they are a key driver in alpha generation today. The ability to produce returns above the market benchmark. This domain is heavily influenced by quantitative models and engines that make lightning fast decisions based on complex mathematics. So, quantitative finance or quant trading is defined by using mathematical models to identify and execute profitable trading strategies. The adoption of AI represents a significant evolution from traditional statistical models to complex machine learning algorithms. So, I used the term alpha earlier. It's basically just the excess return you generate above the market, the true measure of a model or an investor's skill. AI is primarily focused on enhancing the capacity to find new sources of alpha. So, let's dig a little bit deeper. The core task of an AI trading team is model building. This process starts with feature engineering. That means identifying and transforming data inputs that might predict future price movements. These features go far beyond price and volume. They'll take into consideration a lot of fundamental data, traditional data like earnings reports, debt levels, cash flow, and they'll transform them into ratios like your price to earnings ratio or PE that we've commonly referred to. They'll also look at highly granular data on order book depth, bid ask spreads, and trade imbalances used mostly in high frequency trading or HFT for short. They'll also look at some alternative data, non traditional inputs like satellite imagery to count cars in Walmart parking lots to predict sales. So they'll use credit card transaction data and critically sentiment data derived from NLP analysis of news headlines and social media feeds. I think it was Ray Dalio that was famous for flying a helicopter into China to look at something. I can't remember what it was, but to get an edge on a trade. So ML models, particularly deep neural networks and gradient boosting machines, excel at finding nonlinear, complex relationships between these hundreds of features that are utterly invisible to the human eye or simple linear models. For example, an AI might discover that a combination of rising oil prices, low bond volatility, and a 20% increase in negative social media sentiment about a specific sector suggests a market correction is likely, perhaps. That was not financial advice at all, definitely random, but it could be. In the fastest corners of the market, high frequency trading, AI's role is execution. So HFT firms rely on AI to analyze market data, often transmitted via high speed fiber or microwave links, and make a trading decision in sub millisecond timeframes. The AI is not just deciding what to buy, but how to buy it. Execution algorithms are often called algos, are trained to minimize market impact, the price movement caused by the trading firm itself. The algo breaks a large order into thousands of tiny pieces, sending them to different exchanges while dynamically adjusting the price and timing based on real time order book fluctuations, always aiming to seek the optimal price and minimizing its own footprint in the market. In this world of high speed arbitrage, algorithmic execution, and the technological arms race between exchanges sounds fascinating. I highly recommend reading Michael Lewis's book, Flash Boys. It does a superb job of highlighting the origins of this trend in finance and exposes the intense competitive environment that birthed these ultra fast trading systems. So, to wrap it up here, the integration of AI and machine learning is acting as a powerful accelerator across the financial industry. While it may not change absolutely everything, it is undoubtedly one of the most influential tools to emerge in decades, probably since the internet, significantly driving efficiency, personalization, and risk assessment capabilities. So that's the end of the episode, but let's talk about some stock picks. We didn't do one last week, I don't think. So first up, Riley's swinging for the fences with a short on Nvidia at $188 entered Wednesday, October 8th. So let's talk about maybe why Nvidia has been a beast, up 37% year to date, nearly 3x from its 2024 lows, but it's not invincible. The stock dipped Monday after AMD's blockbuster OpenAI deal stole some thunder, hinting at cracks in Nvidia's GPU dominance. Riley might be betting on a pullback, especially with Nvidia's high valuation, sky high. Market cap's a cool $4.5 trillion. Plus, something that we talked about last episode, whispers of circular revenue concerns from Goldman Sachs and various other banks, and competition from AMD and Intel could add some pressure. We'll check back in next week to see how you're doing. Let us know what your stop loss is. I'm very, very curious. Now, I want to give a big shout out to one of our anonymous listeners who crushed it with a buy on AppLovin APP at $581 after Monday's close. As of right now, App's at over 600 bucks. I think 630 almost. That's a massive gain in just a few days. Monster return, Anon. Take a bow. We're all clapping for you. App's been a rocket, up 85% year to date, like we said earlier, fueled by its AI driven ad platform, Axon 2.0, which is killing it in mobile gaming and expanding into e commerce. So it was an interesting entry at Monday after the close because we had that SEC probe into alleged fingerprinting data practices that spooked the market, causing a sharp drop earlier this week before it started to bounce back. So it looks like our anonymous listener scooped up some shares on the pullback and is definitely being rewarded now. They timed this dip like a pro, catching the recovery. So just really quick, congrats to Anonymous. You're making us all jealous. So, folks, that is all we have for today. That was the episode deep dive into AI and machine learning and finance. We covered the personal touch of the customer experience, the massive efficiency gains in regulatory technology, and the complex competitive world of quantitative trading. I know not most people listening to this are ever going to get into quantitative trading, but I do think it's interesting to talk about and good to understand how they operate in the market. The future of money is heavily influenced by code, and I hope this episode has helped you decode a few more lines of it. No pun intended, definitely pun intended. um, to stay connected and continue your learning journey, be sure to follow us and our sponsor, Trajecta University. You can find us on Instagram, LinkedIn, and Facebook by searching for Trajecta University. That's Trajecta University. Also, check out our YouTube channel at Trajecta_talks, where you can watch this episode and find a ton of other great content. All the links are going to be in the show notes down below for you. Join me next time as we continue our conversation about building your financial future. Until then, keep learning, keep investing in yourself, and keep building your future. I hope you have a lovely Friday. Take care, and I'll see you next week.